Everyone. Glad you could join us. This is a series of webinars that we do sometimes every week, not always. And it's really just to look at the markets from top down, from global macro, which is led by Henrik Zeberg. And then we go all the way down into Bitcoin's fundamental structure, and then we go straight into the microstructure of the coin markets and the flows within crypto. So that's with Yann. And this is put together as a collaboration with myself and Swissblock. For those that don't know, Swissblock is an OG trader in the area. It's been trading crypto for over 10 years, and no one really knows about them. But you might know Glassnode, which is a product they spun out in what was it, what year was it? 2019, Jan? And yeah, anyway, let's hand this over to Henrik, and then we'll do our three parts, covering each part of the market, and then we'll open the floor for a Q&A from the audience.
All right, super. So just before we start, I just wanted to welcome obviously everyone to the webinar. This is like Willy said, a combination of all of our perspectives on the macro and Bitcoin landscape. We just wanted to start with a quick disclaimer, just that everybody's on the same page. To just please note as well that this webinar does not constitute actual financial advice. This is opinion. Everything discussed reflects only our personal opinions on the topic at hand. Always conduct your own research and consult a professional before making any financial decisions. Participation is voluntary, and the information provided is indeed for educational purposes. To break it up quickly, it's going to be about 45 to 50 minutes. We'll start with a 30-minute discussion between us three, and then we'll open up the remainder of the time for questions.
All right. And maybe I should start out with the big picture again, or the macro perspective. And as I say, well, sometimes it's good that macro is not interesting, because that means that we are in an environment where things are steady, and we can start to see, the developments that we have seen over the last couple of weeks here now, where things are starting to move up again. We have a strengthening of equity markets and also crypto. But let's have it anyway. And again, back to the business cycle, as you know, we're looking at the leading indicators, and this is now from prime of July, so the beginning of this month. And we have seen that we have a little more decline on the leading indicators. We have not seen a crossover with the coincident indicators. And we're seeing actually also a little more of decline on a monthly basis on the lagging indicators. What does all of this say? Well, this is the moment where we see the Titanic hitting the iceberg. That is the moment when we have a crossover of the red with the horizontal line. And the moment that happens, that is the moment we start to be, we can say that we are in a late cycle, which is also supported by what we see with the central banks, not the Fed so much, but which have been afraid of the tariff or the effects of tariffs. But if you look to central banks around the world, you'll start to see that they are actually starting to stimulate their economies, because they see that there is a slowdown in process. And so we wait for that crossover here with a coincident. But until we see that, that is the time, and this is where it's sometimes difficult to be patient enough. Henrik, you've been saying going to have a recession. Yes, because we have a crossover. That, in my book, is a very certain sign that something is coming, and we just need to see now and analyze the coincident indicators for when that is coming. At this point here, early July, we don't see any imminent dangers, and all what we can say in terms of the what I call imminent recession indicators are not flashing anything. These are the yield spreads. We don't see a strong spike in that. We don't see short-term yields declining very fast. We don't see the labor market actually with where we had the initial claims yesterday showing any signs of that. Not if you look at on the weekly basis, but if you look on the continued initial claims, continuing claims, then we'll actually see that is actually starting to head up, which is a warning sign. And this is where people we need to be observant on these early signs of weakness in the labor market. I'm still, surprised to see that the Fed apparently does not pay so much attention to it, but that is one of the signs that we should be looking into. But for now, we are in an environment where things can slow down. It's like the car is, braking. It's not coming to a complete halt yet, but we're seeing that the speed of the car is it's braking simply the car, right? And that's what we see with the economy at this point. So, but no crossover. We are in an environment where fantastic things can happen because we have liquidity coming in. That is what is happening as when the central banks comes in and start to stimulate the economies to avoid the recession and the slowdown that we see right now. And that the Fed is not doing that at this point here is actually not to the degree that Trump wants, but also that I think would actually have been prudent at this point here to support the U.S. economy. Well, that is something that will have to be discussed in history when we get to some years down the road. But for now, things are fine. We have an economy that is not falling into a recession, even though we have a slowdown and liquidity is coming in. So that is actually the supportive of the whole risk-on rally that we've seen in equities, and we've seen equities actually performing quite strongly. And now we seem to see that is now spilling into crypto. And I could even see a situation where we have equities maybe not having the best summer. We very often see the summer doldrum, but still having actually altcoins and Ethereum, Bitcoin performing really well in that period. And that's what we're going to talk about today. So let's put it like this: the coast is clear for further upside in the market. Liquidity is coming in. So what's not to like, guys? Willy?
Actually, Henry, I have a question on that. The top panel with the leading indicator, particularly the red line. How like once we hit recession, it's generally where it bottoms and bounces. Is the absolute depth of that oscillator does it give us an idea of just how bad the market is, the bear market?
Good question. Yeah, it actually does. And as you can see, also the depth of the 2001 was not so deep, and this is because the reason is because it's related to the housing market as well. The housing market is actually leading the economy because you know from yourself, if you have a mortgage loan, the interest rate starts to go up, and the interest rate goes up in good times. That's where the Fed is starting to hike, and also yields are moving up. Well, then you'll start to say, well, I can't afford this kind of investment in my house, so I'll cut back on that. When it goes up even higher, you may have to cut even more on that, and you may not be able to remortgage your house and so on and so forth. So that is why the deeper we see that, the more affected the housing market is, and the harder we will actually have the landing of it. And right now we see actually the housing market is, when we look down beneath the leading indicators, actually getting hit quite badly, and also the yield spread, which is also one of the leading indicators, have actually gotten hit quite badly. So that's also why I'm saying I think we are on the process here of seeing a severe decline. And at this point here can be compared to what we have into Corona. Remember again, it actually picked up on the decline into Corona as well. That was a slowdown of the economy as well. And we are not even seeing the bottoming of the leading indicator here. So it's a continuing decline of that, which I think could be worse. So yes, to your answer, to your question, the deeper we see this, the harder the recession. And that's what we see in the depth of the red one that we have over here. Down on the coincident.
Oh, thanks. Because the premise right now is Bitcoin's very, very strong. We're not seeing the same sorts of weakness we saw in the last bear market with all the crap that happened in 2022 with all the blow-ups and over leveraging. But even though Bitcoin's quite strong, it looks to me, well, particularly from your work, that the global macro looks particularly bad. So a lot of people have been thinking we might get a 30% pullback, a 50% pullback, but I don't think Bitcoin's ever existed in a time where
Right.
we've had a deep, deep recession. It was birthed just after the biggest one, which was the 2008.
Right. And I think that is that I think is the right kind of pair of glasses to wear actually, is that how will Bitcoin perform in a real recession? So what happened into Corona was that we had a recession. Yes, we had a 2-month recession, and we saw a pretty deep pullback in liquidity and in Bitcoin as well. We know liquidity, and Bitcoin is a gauge for liquidity, and you guys know more than that about that than I do. But as I see it, if we get a severe liquidity drainage into a kind of a balance sheet recession, if the housing market is not well, then you can see that open. The gap in the ground simply open up and liquidity dropping into that, which then potentially could be bad for Bitcoin for amount of time. And then people say, yeah, Henrik, but as you know, the Fed will come in and save the day. Correct. But we also see how sluggish they have been on actually getting in at this point here, where we already are starting to see some signs of not of an economy slowing. So they are terribly late at this point already, as I see it. So I would just caution that even, a shorter period of, let's say, 3, 5, 6 months of drain or of liquidity shortage, which I could see, and a dollar actually soaring, what will then happen in a recession to Bitcoin? And that's where I don't think we see it right now because we have the economy is still supporting all of this, and we don't have the floor is not opening up. What I'm talking about is the situation you had really here, as in 2008, in March of 2008 until September of 2008. That was the period where liquidity kind of began to vanish, and you had banks actually starting to blow up. We're not there yet. We're not at that point because but we're seeing the consumer getting crushed at this point, which then will affect banks at some point, which then will affect, the losses that we have there. And that's why I think it can be bad. But again, we're down the road now, and that's where global macro is, when it's boring, it's good because then you can stay in that for some time, and then we need to observe it. But I think the global macro will at some point come haunt the development in Bitcoin, even though I'm very bullish at this point still.
Yeah, and certainly Bitcoin's global macro in this cycle. It's certainly multi-trillion dollars now. So
Yeah, but
um,
definitely.
the newest really in 150 years. All right, I'm going to share a screen and take a look at the liquidity flows within Bitcoin. And bear in mind, Bitcoin's pretty much liquidity driven, capital flows and money printing and how much of that hits the network. And probably the first one I'll go to is the macro risk, macro cycle risk. And what this chart really is picking up is liquidity in the Bitcoin network. And it's looking at pricing structure and it's looking at capital flows. And so you'll see that it's very, very good at determining where we are in the cycle. When the risk starts to ramp up, it means that the liquidity powering these price moves is starting to drop away relative to the size of the power moves, is one way you could say it. And so the risk starts to climb. And we might have a look at the 2017, right? And once it starts rising up into the 100% zone, it's not the top, it's just a warning that the top is coming. So we're late cycle. But during those times, we get these dips, right? The dips are little influxes of liquidity and it powers us up for the next leg. The tops of the cycles are very unstable. It's very volatile and very sensitive to liquidity ins and outs. And so, like, we'll just go here, and you'll see that the bottoms are marked where liquidity comes back in, and in the zero risk area is the liquidity is plenty fine to mute all downside sell-offs, and we just tend to go up with very, very little risk. And then we entered early this year the late cycle because liquidity started to drop away. And just zooming in here, this was the prelude to our breakout all-time high, which is a little influx of liquidity coming back in. It also came in here when the things were looking very, very bearish. It came in and it supported us up all the way up, and it actually didn't stay at the high risk zone for that long. But this is very, very healthy, especially in late stages of a bull market. Any drop like this is usually enough to send this thing price higher. And if we were to look at another view of capital flows, some sort of like liquidity, this is measuring the amount of capital hitting the network. And you can see that we've staved off a bearish pivot back in June, because when the flows start to roll over, that's a locally bearish structure. You can see that when it rolled over, the incoming flows coming into the network are dropping away, and that's actually bearish. Even if, like, right now, see in this zone here, it's like $2.5 billion a day hitting the network. But the fact is, as the flows drop, that's not enough buying power to keep price up, because it was sustained by a higher amount previously. So we were starting to roll over, but that got watered off into a very neutral zone of consistent flows. And that led to most of the price action here actually being driven by tactical trades and liquidations. And you'll notice that right now, this big pump up here actually wasn't really driven by fundamental increases of flows into the network. And so given that the model that's detecting liquidity and the risk model that I showed earlier, where is it there, is dropping away, that's detecting liquidity injection on the exchanges. So the lot of the price movement has been from actually what's happening on the exchanges, and that has not yet rolled out into the network. Sometimes if you're going to do a big buy order, and it doesn't register on the network until you pull those coins off the exchange into the network onto the wallet. That could be an explanation, or it could be just speculative, completely speculative. And to have a look at this, let's take a look at the liquidation heat map. No, it's not. It's not giving me the. I know I have to stretch the screen. I think there we go. There. So what really triggered this fast move up was us breaking into these really hot bands of liquidations of short positions. So that's been cascading. And as those guys get liquidated, their sell order turns to an immediate market buy, and that creates a huge urgency, and we're running up. And right now there's a big gap. There's a big gap here. And so it looks like it's still running, but there's not much in the way of liquidations to keep moving upwards. And given that the capital flows are very neutral, it's still in a tactical like regime, right? It's really looking for traders to get liquidated. So that's a fundamental structure. We do have, a decent momentum that's built up. And that might take some time to turn around. And just going back here. Like, where does it end is the question. And I want to show you where we are on our kind of medium-term models. And so let's take the yellow one, which is VWAP. Let me turn that label on. That's a VWAP model. And all this is really detecting is the coin being overbought or oversold over a medium term, multiple weeks, and it's using on-chain volume and pricing. And so when it gets really high, it doesn't mean it's a top. It just means it's overbought, and it's really hard for the system to keep moving up with great momentum, and it starts to grind. And other times it actually picks the tops, right? So it gives us a kind of a tailwind or a headwind based on overbuying or overselling. And right now, it's such a healthy spot because number one, this is coming out of an oversold position. So there's plenty of headroom to move upwards. So the headwinds from VWAP is not going to kick in. And then when we look at the paper models, sorry, the paper markets, this is the speculative sort of further that's happening on the market. It's been very, very cool. And I'd be worried if we're overheated with over speculation, but that's very, very cool. So it's actually a really good structure for moving upwards. We're out of the zone of easy squeezing, short squeezing. So we'll need to move up from people getting FOMO and buying. But overall, I'm not seeing a top in this move. If we zoom out, it would be kind of a mismatched anyway, in terms of the type of moves Bitcoin makes once it breaks, a half-year consolidation, pretty much. We did a half-year consolidation and a step move up. So I think we'll have pauses along the way. We're entering a zone where a pause is likely, but certainly I don't see any weakness in this. I think nobody sees weakness in this. But what we do need to watch out for is when do we reach the top of the cycle. I believe Henrik picked early September, maybe even October. one thing I'd speak to is another view of liquidity here. And um, liquidity is dropping away here, and you can see it's there as well. It's a prelude to the top. And when it crosses the dotted line, these are like a standard deviation, statistical view of how it's moving. And as it crosses the dotted line, it's typically the sign that the top is coming, but we don't know when. So just beware that we have a top coming. It is late cycle according to the liquidity model. According to the macro models, we're heading into recession. And even though Bitcoin looks mega, mega strong, we've never seen Bitcoin deal with like a full-blown recession of strength, not since its invention. Jan.
I mean, may I just say, because I think it's fantastic, Willie, because with your background and everything and how you've been, approaching Bitcoin and
You're dropping in and out, Henrik. Is that me?
oh, sorry about that. I think it may be me, so I'll just be quiet. Can you hear me?
Yeah, it's all good.
Okay. No, so I just want to say that I think it's interesting to see, and I think there's a lot of learning in this that even though with your background, how long you've been with Bitcoin, that you are being caution on what we are seeing going into what macro potentially can tell us that can be happening. Because I think there are a lot of people out there maybe a little too optimistic on say, yeah, well, Bitcoin is the new thing, and it's just going to go here into infinity at some point. Whereas you're having a more say, yeah, well, there can be potentially be some kind of an end to it. I don't want to say it's not here. I'm not bearish or anything, but I'm just saying it's that the macro story, the macro environment can eventually play in. So I think that is something that people should listen a lot to, and especially with your background. That's just what I want to point out.
Yeah, I'm definitely cautious. I'm definitely cautious. And if bear market hits early, because markets have a really good way of screwing you. The most people think December, which is very crystal clear kind of timing in the past cycles. Just because it's so global macro this time, it's traded global macro. I think it's much more captured by the flows from TradFi. And I don't think things work that like clockwork in these really big markets. And so I think it's going to catch a lot of people off guard. Maybe it'll run beyond the November, December and into Q1, or maybe it'll catch people off guard and come early. I don't know. We'll see it as it forms, though. I think we'll
Absolutely.
start to
Well,
see it as it
let the
begins
data
to
let the
form.
data speak. But one thing we are seeing, I don't know where Jan or you'll take us, but I think the strength in Ethereum, right? I think that is interesting to look at right now. Jan,
Yeah, I'll definitely dive a little bit deeper into that. But I think to your guys' point, Bitcoin is oxygen, right? So without a strong Bitcoin, without a Bitcoin that is stable, you will not get an alt season. So I think this is always something that we have to keep in the back of our heads and something that we should always be very mindful for. So I think 80% of the the focus when you do these types of structure analysis, really when you look at your portfolio construction, really has to be a strong thesis on where you think Bitcoin is going to go. And obviously you will have those moments like we had back in November, back in February of this cycle as well in 2024, where you do have rotation into Ethereum. And I think that's where the next part of our framework and the way that we layer our approaches becomes very important, because at the end, the big returns, they happen in those very small pockets of time where risk goes fully in the opposite direction. So for those of you that have joined in the past, you guys remember that we divide the entire understanding of structure into two main categories, one called strategic and one tactical. Strategic, we define as an environment where you can take on full-on risk, take leverage on, especially on the majors like Bitcoin, Ethereum, and tactical environments where there's a mixed bag of all types of things. Trend, massive spikes in volatility, both up and down, but generally range bound. So we're referring to mostly periods like February all the way to early mid-April, and last year between basically late May, early June, all the way to basically mid-September. These are periods that are extremely difficult to trade, where the day traders tend to outperform because they have a very good way of risk managing and basically trade the boundedness of the system. What is interesting, actually, for those of you that actually follow us on our advanced channel, so to give an example, on the Bitcoin Vector advanced alert system on Telegram, you guys have probably noticed that we actually flipped from a tactical into a strategic environment early morning UTC. So this signal got confirmed at 4, but started triggering late evening once we started moving above 113,000. Now, why is this important? So obviously the trend was really building up all the way from 107,000 to 113. But our strategy, or the systematic strategy, takes into consideration volatility as well. Because a lot of times you get the fake outs. And that's what has caught a lot of people off guard, especially over the last 2-3 months, where they thought that the Bitcoin was basically ready to break out. But we could see from a structural perspective that was not yet 100% the case. Because you need things to basically, it's like sedimentation, right? When things fall in water, you need to let it settle before you have a strong enough foundation for things to start moving and basically using it as a springboard to move further up. This was basically a consolidation of that. And I think this trigger here, to me, confirms that we are in the first leg of a major shift in the market and the first leg of alt season. To put that into perspective a little bit further, you guys remember that the last time that we had this was back in, to give a little bit more of a context, it was basically back in early November. This is basically mid-October to early November. What we're seeing today is more akin to early to mid-October. So we're starting to see alts recover faster, starting to catch up to what Bitcoin is doing, led by Ethereum, Solana, and Ripple. It's going to be interesting to see which one of those is going to take the cake. It looks like Ripple might actually come out of the blue here as well, right? So there's a lot of different things happening, but very indicative of these environments. So we're looking at things like February of 2024, November of 2024 as well. So mid-October to early November. For those of you that actually follow us on Twitter as well, we did indicate the bottom being in, basically this was in the 7th and 8th of April of this year. That was the actual global bottom of the system. And ever since then, what has basically happened is that we've had a 3-legged cycle, starting with a recovery, continuing on into starting with a global bottom, continuing into an actual first phase of recovery, and then creating the foundations for an actual alt season. The last time that we saw this in this cycle was the combination of February and October of last year, culminated into a global bottom around June, July of last year, August, July, basically. That then led into October, which was kind of the first step of the recovery, and then into alt season early to mid-November. That's when the entire thing started to move the opposite direction. As you can see as well, that was underpinned by a strong Bitcoin. So it's super important to remember that we need oxygen for things to grow, right? The trees in the forest will not grow if Bitcoin doesn't allow for it, because that's where the reservoir, like Willy always mentions, that's the reservoir, the thing that people use to store value, to store energy. That energy then needs to dissipate into everything else. Ethereum has started to become that as well. For those of you that were there 2 weeks ago in our last rendezvous, we did see the early signs of that rotation. We've now actually had a follow through. For those of you that follow us on the Altcoin Vector, we've gone much deeper into that transition and the impact and the importance of that transition. But that has been especially the case in May of this year, where we had the first rotation into Ethereum, where Ethereum was starting to become the store of value, and now seeing the confirmation of that. What is also very interesting is that during those times, where you have a strong Bitcoin and a rotation where Ethereum starts gaining relative strength versus Bitcoin, you also tend to have an indication of risk taking, and that is not in any way better represented than in memes. Memes are the flagship of risk taking. So when memes start outperforming everything else, it means that people are really starting to go out in the risk curve and take disproportionate risk, which is usually a very good sign, especially in the situations like Willy mentioned, where you basically have a VWAP environment that is absolutely not overextended. You still have a lot of room to grow. You also see that on some of the Glassnode metrics that are very valuable in this situation, looking specifically at profit loss. So you see that the short-term holder profit range that you would attribute to tops and cycles are still quite quite a distance away. So that means that we still have quite a bit of room to go. And we're actually setting ourselves up to a potential actual continuation of the short squeeze that could actually lead Bitcoin to the mid-30s, 130s roughly, right? If this pattern continues. So definitely getting closer to explosive moves. To Henrik's point, obviously, you always have to be cautious. Volatility is also going to pick up as we get into that. So to bring it back into the analysis, this is where we stand. So we're not only in a strategic environment, but we're actually moving into a recovery. Recovery is the beginning of all the major explosive moves that we ever had, started with a recovery in Bitcoin. Okay, so really strong trend and volatility induced environment. In the case of November, that got underpinned or defined by a massive move in Ripple. Okay, for those of you that were there, to give an example, to quickly just transition into that, so that we are on the same page. What that basically looks like is something along these lines. November, we basically had this year. We had a recovery phase that was, as I mentioned before, early mid-October. That's when the actual algorithmic trigger of recovery and strategic environment was first flagged. And then it was basically kicked off and started by a massively explosive Ripple. Now, see here on our impulse framework, which is the one that detects imbalances both to the positive and to the negative side of an asset. So to be able to go long or short, you saw that got triggered right at the moment when Ripple started to break out of its range. And that to us was the signal that things were shifting. There was a massive shift within basically 24 hours into the opposite direction. We're starting to see the first inklings of that. More specifically, if you go into our holistic analysis, we're seeing not only capital flowing into Ethereum, which is again the massively important component for continuation and actual persistent alt season, but we're also seeing a strength in Bitcoin that we have not seen since the massive explosive move out of the bottom that we basically called on the 7th, 8th, and 9th of April, that was underpinned again by our alt impulse, right? So the aggregated alt impulse, we look at the top 350 liquid assets, and we look at how exponential, positive or negative their price structure is. Usually, when all of those things tend to go negative, that usually is a capitulation event. That usually signals bottoms, especially global bottoms. The last one also having been back in early August, July of last year. The last thing that we also saw that back in November, you saw here, we had a similar type of setup where we had relative weakness going into consolidation phase, which was mostly most of June. Same thing that we saw actually in October, that then actually got triggered into two different stages. Stage one was a reignition of Bitcoin and Ethereum, and stage two was a rotation stronger into Ethereum, eventually into Ripple, and then a massive flow into the rest of alts. And that's exactly what we are setting ourselves up for. If you look at the total number of positive impulses, we're right now at 15%. Historically, the really strong alt seasons were started when you start going above 18 to 20%. Once we overcome that threshold, you're in a very likely, consistently persistent, strong alt season. So we're very close to that. Not there yet. We're starting to see some rotation into L1s. What I would like to see for me to be more confident that this is the case, I would like to see something similar to what we saw back in November, where you see strength in Ethereum and then a rotation into large caps. So things like Sui, Ripple, XLM, and Cardano. Once that happens, the chances of an actual alt season go up to 80 to 90%. To consolidate that a step further, when we look at the individual impulses, you already see it here. This gets updated every couple of hours because these impulses need to get confirmed on an individual stochastic level. But you see that we are really gaining strength, especially in areas that are consistent, which we call hot opportunities, that are consistent with structural components in the microstructure that tend to create strong foundations for those assets. And you're seeing here that we're getting a massive increase. To give you a relative perspective, we were at 1% 24 hours ago. So we've gone from 1% to 15. It can very well be that we take a breather into the weekend. It's still not clear how that plays out. I think equities, we're going to have a little bit to say on that front as well. And I think, Henrik, you have a very clear view on that as well, that we probably have a summer doldrum on equities, which might have a short-term effect into the ability for Bitcoin to absorb some of that liquidity. But I think next week is going to be an absolute, to use the word bacchanalia of explosion in altcoins. So we will be writing about this. Remember that we also have the our Swissblock Vector and Swissblock Bitcoin Vector and Altcoin Vector series, where we go deep into exactly what is going on, and we follow through as well with updates, pretty much on a live basis as they happen, with explanations of how things are moving. So for those of you that want up-to-date information, especially over the coming months, I would highly suggest that you sign up to this. I think when it comes to alt season, remember that it takes 10 days to make 90% of all the returns. So you have to be in time and ready to go, because once things start moving, it becomes very difficult to position if you don't already have a strategy beforehand. So having said that, I don't know, Willy and Henrik, if you want to add to this. I think maybe explaining some of the summer doldrum points might be of interest. Willy, on the liquidity side, do you see that as well for Bitcoin?
Well, right now the flow is very neutral. As you've said to me, often we think of summer lulls, but actually what it is a drying up of liquidity, and that sometimes can just mean more volatility because there's less participants in the market, and so certainly we've squeezed up a lot through tactical trading, even though the actual capital flows have been very, very neutral. So yeah, I don't have much else to add to that.
No, I can just say that I think we have seen what was expected back in April, when everybody was so bearish that we should see a very powerful development in equities coming out of that bottom on the 7th, 9th of April. We have seen that, but nothing moves in a straight line. We know that. And we've just gone past the all-time highs. It doesn't mean that things will just keep going up. And if you look at the extension levels here, it seems very much that we could see that there will be some kind of a sideways movement. So I think there is a good chance that we could see a sideways to down movement, I would say, in equities at this point. And we also have to remember that equities was actually leading this rally here. So I think we're going to see that. Well, they may also be leading us into the decline that I could see later on. So also for Bitcoin. So I think what we're seeing is a summer doldrum that will maybe start soon, or maybe has started already in equities, and then you'll see some kind of capital rotation going into late summer, and then you'll probably see somewhat of a decline in risk assets going into even later summer, or even into the beginning of autumn. But that again, the summer doldrum could be on for equities at some point, and I think we'll have to see how that plays out into altcoins, because as Yann said, we don't need a lot of time to make the big moves. And if we see 7, 10, 15 days of the strong rally, well, then it would make sense that you can see also some kind of a consolidation at those levels. So the volatility will be high, but and it's about being in at the right time and identifying the right coins that are going to move, unless you're just in Bitcoin.
In mind as well, which is very interesting, much more akin to what we saw in 2021, is that we really have not only memes outperforming, which I think is a strong sign of risk taking, but you have L2s and ETH beta following. The reason that is important is because we have a increased narrative from TradFi as well, looking at things like Arbitrum with Robinhood, right, where they're really starting to use the application layers to actually start making features that are going to propagate utility. And what you see as well in our signal framework, especially on the narrative side, we're seeing a lot of those L2 coming through with strength. So having much more relative strength versus other things, and ETH beta as well. So that's a sign of not only price going up, but actual utility and activity. Okay. So long story short, we want to see that continuity, because that basically tells us that we have utility. Utility is really coming through the system, which again is another further reinforcement that we will have something that is more stable than what we saw potentially even in November. So it's much more similar to what we saw back in February, and especially what we saw early 2021 as well.
So we
given the time, go ahead. Should we move into the questions?
think maybe we
Sure.
should, yeah.
Before we do that, I'd just like
Yeah.
to everyone to know that we launched, the Bitcoin Vector is for institutions and pro traders. It was something we built for them. It's quite technical. Last night, we launched the Lite version, which is going out on Substack. So, if anyone is interested in that, that's a very easy reading and a simplified models. It's really designed for retail to find best times to stack sats and also to know where we are in the general cycle so that you can plan accordingly. So if you want to take a look at that, that's on Substack, willywoo.substack.com. And right now we're running a $21. It's normally $29. We're running at $21 approximately. That'll expire on 21st of July.
No,
Yeah.
just to add on to Willy's point, it's a good for those of you who are still looking for ways to improve your framework, don't have all the time in the world to make daily and even intraday decisions. I think it's a good place to start. It's like a backbone to then build on top of. We also have at the end of the publication different ways that you can interact with altcoin and Bitcoin Vector, so that you can get more details once you have an understanding of what it is that you actually need and require for your portfolio management.
Question for Henrik. You mentioned on a recent webinar there was no rush to consider a recession until the red line crossover of coincident indicators index. There was a middle chart. But in the dot-com crash, the red line crossed over after the S&P had already topped. The model flashed recession in February in 2001, and the S&P was already down 20%. For the great financial crisis of 2008, the model flashed recession in November 2007 after the market had topped in October 2007. Very close, but does that suggest that the red line crossover happens in the coincident indicators index that the market is really likely to have already topped?
So
Yeah.
it's always a relative game, right? And that's why if you look at the setup here, let me see if I can just find it here, what I call the Zeberg Solomon protocol, really from the great guy who's been helping me programming all of this. And what you look at is always a relative game. So if you look at it from I need to get out of the market also entirely and stay in cash, well, that's one thing. But if you look at it in a way that say, well, when is it that it's time for you to actually go into defensive action assets and say, let's say long TLT or long bonds, I could say, because it's always, if you go back in time, it wasn't, the ETF wasn't established then. But if you look at it like that and say, well, it's not just about when you get out. Actually, this is when the model would have gotten us out at these in these different dips that we have had. And as you can see here, back in what was that in the early 80s, we got out earlier before the top actually was in, and we got in a little later. But in relatively terms, you would actually gain on being long TLTs or bonds at that point. So that is why that when you say it's actually getting us out, too late or too early, this is the returns you would have seen if you follow macro here. That is the SPX TLT setup. If you say, well, you get out of equities at the point of where the model tells us to, and into bonds, long-term, long duration bonds, you will actually have gained a 42,000% since November of 75. 50 years. I know that's not a lot in a Bitcoin world today. That's like, what you can gain in a month. But back in the old days, it was pretty good. And you would actually outperform the equity market by 7 times. So the model here is really about, what do you do when the model is telling us to get in and out? If you follow this, on just like that, you will actually get these kind of returns. So obviously you will never get the top at the, but very often, as you can see here it gets you out around the level of where the top is, and then it will get you into safety and something that will outperform equities for some time. Because remember, when we have declines here, that is what the model also is telling us, that when we see that the equities are starting to when you get out of equities at this point here, well, then you'll actually see that the inflation and yields are declining, which is what we see down here, and that's where you want to be long TLTs or bonds, long duration bonds. So following this is where you can get that. And obviously it doesn't get you out. Oh, sorry, this is the wrong way. It doesn't get you out at the top every time, but it will relatively give you a better performance if you follow that kind of structure. I hope that kind of answered it.
And with most of the CTAs that we've been talking to over the last 4 or 5 months, their biggest regret was selling in February, March, because the V-shaped recovery was so fast that they basically went from being neutral to actually underperforming the S&P index by significant margins, right? 15, 20%. And I think what Henrik showed there is the equivalent of what Willy and myself are doing on the crypto part, which is really understanding, is this an environment, kind of defining it as the strategic and the tactical? Is this an environment where I should, bite the bullet, hold tight and buy the dip? Or is this an environment where the risk is really there and I need to start actually divesting, reducing my overall asset exposure? And I think this critical question is a massively important foundational question for portfolio management on any level.
And then just to dive into some of this, we all remember in 22 when everybody was jumping in and saying we have a recession here at that point. We did not. This was the model was quite certain. I was quite sure about that. It showed us that the leading indicators were up here. So at this point, we saw the coincident indicators were actually, and we also thought that we don't need to talk about the lagging in that respect. We saw it also here when we had this in April. We saw that we did have the crossover here, but we also know that we need to see a significant decline here in terms of the coincident indicators. Also back in 23, when everybody was talking about when we had the banking situation, also the model was quite sure of this is a buy the dip opportunity. It's not a recession that you're seeing at this point. So this is the difference here. That's why it's not about being right to the top. It's about being relatively right on being defensive or riskier assets, and then get out of the market when the model is saying, okay, now the tides are turning here, and we're going to see something of a big decline. But also to dismiss every time we hear the calls of recession. And just remember how many was actually talking about a recession when the leading indicators were all the way up here, and the coincident indicator were actually rising. This is why we have that there is a lot of strength in this, and it gives you an idea of is this a buy the dip opportunity, or is this something we need to take care of seriously? And that's why I will be more serious when we start to see this kind of decline at some point than I were in April, where there were not the signs. Just a little elaboration on that.
Global liquidity is measured by cross-border capital dipped in Q2, April, June. So with the lags, so you think this means a major dip in Q3 and then another leg in Q4 into Q1 2026, as per Raoul Powell's thesis, or do you see a top in 25? Thanks.
I mean, I think we're going to see somewhat of a pullback at some point. I think what Willy is talking about will develop into some kind of a pullback, and I think it can be stronger than most people expect. But we also haven't seen the final card from the Fed just yet in terms of actually coming out, and I think that could potentially send us into the banana zone that Raoul Powell is talking about. So I both see strong Bitcoin, but also, as Yann and Willy also said earlier on, that we could see volatility picking up, and I could see that after going into the summer, maybe led, as I said before, by equities. But I don't think that'll be the final thing. I definitely think that there'll be a lot of talk about the top, but I don't think it's going to be the top. I don't know, Willy, how you see it.
Yeah, I don't see it really. I think it's really hard to pick tops. I think they're one of the hardest things to judge because they're so unstable. So the best we can do is keep an eye on the liquidity dynamics and the capital flow dynamics coming to the network. And also bearing in mind that Bitcoin's the most sensitive to liquidity out of the global macro assets. And so it could happen on Bitcoin early. So that's what I'm doing. I'm just tracking liquidity flows in Bitcoin. We will see volatility starting to spike a bit. But when you see volatility spike and also in a time where the actual flows aren't that strong, it becomes quite dangerous. And so that's what I'm looking for timing wise. I don't know. I'm preparing for an early because it's better to be prepared early than late. But it could be September, October, it could be March, April. Might even run on much later. But I have no crystal ball on it.
Look at everything from a probabilistic perspective, meaning that we will start knowing when things start turning in a direction where you're more likely to see bigger drawdowns, liquidation events, these types of things. Again, once we move back from a strategic into a tactical environment, and I think at the end of the day, it's less about the predictions, but knowing how things evolve, right? So think of it more like So, predictions are a North Star, but we're the compass that kind of guides you through how we actually get to the North Star. And I think this is really, really key, especially when you talk about risk management. And I think the next question is kind of tied into that. Question, Henrik, I remember one of the last webinars where you mentioned, gun to your head, summer, September, top will be in. My question at this point is the case that the Fed would make a small rate cut of 25 basis points on the 18th of September. Can you see the market would rally for a short time, as in soaking in the last point of exit liquidity as a 25 big cut regards the preemptive technical or the narrative or the narrative of a soft landing? But once they cut in October again, market would look at this as something going wrong in the economy. So I think that is in a way what we are saying, right? That I think once the Fed starts cutting aggressively, you already drank the poison in the punch bowl. So that means it's going to be late for sure. And the cracks that are basically going to form under us are going to happen beforehand. And that's exactly what we need to be looking out for as we track all of these different data points. Remember, another thing that we did mention in the previous webinars, the point around Bitcoin being a canary in the coal mine for liquidity. It's one of the first assets that will feel basically the receding tides of liquidity in the market. So that's why I think having the combination of our analysis and Willy's analysis on liquidity is going to be absolutely critical, not only for Bitcoin, but also for rest of assets, for the rest of the world assets. And I think that's exactly where we're kind of heading towards a period where the expectations right now of liquidity are going up, but that will only go so far. At some point, that tide will turn. Not sure if you guys want to add anything to that.
Yeah, I'd say
No.
that's actually dropping. We're getting a reduced we're getting a reduction in the speed of drop of liquidity, and the way I measure it anyway, relative to the size of the Bitcoin network. So it is getting more and more unstable as each month goes by. But we're in a very good spot right now where we've had a little bit of an upswing, and that powers us to the next league higher.
The next question is about SUI and Ethereum. So our view, generally speaking, I think SUI is definitely one of the better protocols out there, right? I think it really has a solid team, a lot of investments. Structurally speaking, I'll let Henrik give you a rundown of the TA, but it is looking like it is really gaining strength here. And if you can see my screen, just to bring it up, what we are starting to see is that it actually is getting an impulse. So the last time SUI had an impulse, SUI is the orange curve on this graph. Last time we had a kickoff in the impulse, like I mentioned before, late September, early October, which is exactly the situation that we're currently in. We had roughly a 500% move in SUI. I'm not saying that it's going to be exactly the same, but we are expecting a bigger move to start playing out in SUI. And actually, to be more specific, we actually just had that triggered late yesterday. So late yesterday, we've had the first innings of an impulse in SUI. It's still slightly weak, so I would like to see more follow through. Again, the limitation there is going to be the Bitcoin strength. So as long as Bitcoin stays where it is and it doesn't go absolutely parabolic, I would expect SUI and Ethereum to follow through, especially SUI. I think SUI has a very strong setup, and I think has quite a lot of room to go up before it gets overextended. What do you think?
Yeah, maybe here, Yann, is where we also the combination we do with the impulse that Yann is talking about here, and then the Elliot Wave extension. When we do our Altcoin Vector report and we have the impulses coming in, well, then we have the team sitting and looking at what could the Elliot Wave then look at, what is the extension could that look like, and this is what we can show you here. Oh, sorry, that's my alarm going off. That we actually for SUI here. Oh, that was SUI right there. That we then can say, well, it seems like we have a bottoming here of SUI in a way too. It touched down on a 61.8, which is a very nice bottoming area, and then it's taking off. And that extension will then lead us to a 161, which as potentially a minimum, which then will be up around $10. It's not, again, recommendation here or anything, guys, but it's just where we have now the impulse here, and we have potential extension. And as Jan said, 5 times up makes good sense here, from 2.5 to, let's say, 10 or maybe even higher. And of course, we'll then follow up on this and see whether the impulse is following through and we get this extension that we're expecting.
Asking as well. So the way that we represent this, I think one of the strengths of our framework is that we can do exactly what Henrik said, and we can basically overlay our framework, which is a statistically underpinned system, and actually use the strengths of Elliot Waves, right? So one of the downsides of Elliot Waves is always this understanding of when a wave 3 actually happens, right? Because the chart tells you that the structure is possible, right? One of potentially many different structures, but it can tell you what is more likely than not. But what has always been an issue, or one of the limitations, has been the timing. And this is exactly what our framework is able to counterbalance. So what we do, and you can see it here, every single time you've had an impulse, that has always been a wave 3 in my limited understanding of Elliott waves, Henrik, and what's the alternative? A B? Is it a B
No,
wave?
it's always a C wave or a wave 3 or a wave 5
or a wave 3.
Yeah.
Exactly. There's always one of those three, and the difference there is the intensity, right? But it is always aligned with one of those, and I think that's where our framework can really add a lot of value on the TA side as well. So we look at this to understand when this starts triggering. We know, okay, it's a wave 3, it's a wave C, wave 5. And then we start looking at, okay, where are the extensions? Where are potential, basically liquidation levels, right? So if you go into
Yann, I need to jump.
Yeah.
Sorry for this, but
okay.
I need to jump
All
actually.
good.
But thank you guys for bringing. I have to jump now. Sorry. Talk to you all. Bye.
See you guys. Yeah. Well, maybe for those of you that are interested, just reach out to us on Twitter, also on Telegram, and we can go much deeper into that analysis. So maybe just finish off with the questions as well. We have so Willy, what are your 3 most preferred metrics for spotting cycle tops?
Yeah, it's these days it's liquidity and capital flows. So liquidity being a combination of capital flows and the long-term structure, pricing structure. You'll see volatility climbing. So that whole model is what I use. And you know, I've shared that on screen. That liquidity is dropping away in terms of the cycle. And so what I'm looking at there for is continued high risk, continued decline in liquidity, and then the capital flows entering the network staying to zero and go negative. And so it's very unusual for the flows to go negative. But when they top and they're consistently driven down, then it's not really good, especially if price is not following. So you know, we know roughly where we are in the cycle. And once the capital starts flowing away, or let's say not increasing, then it's a big warning sign. I'd say it's very hard to find the top though. Like you'll know it in hindsight, because you know the flows can come back in, and so I always say it's better to be late on calling the top than early, because I remember in 2017 a lot of people were calling tops at 10,000, and then in 2 weeks it went to 20,000, and that was actually the top. So you can wait for a dead cat bounce. It bounced to 12,000 in 2017. But it was, you know, you're very assured at 12,000 after that dead cat that was a top. So yeah, that's the other thing I would say, just looking at the pricing pattern. Don't try to exit too early.
The liquidity analysis, one of the very nice ancillary benefits is that it gives you the warning signs. It starts telling you when things really look overextended, overstretched. And from a portfolio perspective, you can start basically reducing, right? So it's always about going fully exposed or fully cash, but you can do 80-20, 70-30, 60-40. And the higher you go, the less certain you are that it could continue, the more you can start, you know, reducing the overall exposure. And that is usually a very prudent way, because like Willy said, you can't time it, which means that you want to be able to use multiple different steps on the way up into that global top to be able to actually take profits. Recently, the Fidelity report, the narrative around ETH has been more well defined. Not sure if you want to cover this in this webinar. It looks like ETH is starting to win the institutional investment game, despite it being slower, more expensive, and less UI friendly. It absolutely is. Like anything in life, like anything that takes on mass adoption, you need a clear narrative, a narrative that you can stand behind. And I think that has absolutely been the case now for the last 2 to 3 months. On the institutional level, it is absolutely clear that there is a very clear narrative again that started with the SEC making or signaling that they were not going to be pursuing any of the cases relating to securities, and how securities link to DeFi, more specifically Ethereum as a protocol. And at the same time, you also have Lex ruling on the actual ETF itself that is now actually giving you the ability to potentially get the yield as well, right? Which is an additional benefit or a positive carry that you get from holding the underlying ETF, which I think is very, very positive. And I think that is going to create a flywheel effect into the use case, adoption, utility. And you're seeing this across the board. You're seeing this with on-chain metrics that Glassnode provides. Glassnode is by far the most holistic, comprehensive data platform for this if you want to do deep research. And you see it very clearly there. You see it in our framework, in the way that we analyze and look at Ethereum structure. It all is indicative of a massive shift in understanding of what it is and also willingness for people to invest into it.
I'd say I have a different view on it in terms of long-term view. Look, we have this dichotomy in let's call it crypto. We think of Bitcoin as a cryptocurrency, but Bitcoin really is like a digital commodity. It's a store of value, and the market for that is 100, $200 trillion. And I think there's been a misunderstanding around these other blockchains that their currencies, cryptocurrency being, but they're not. They're technology, tokenized technologies, let's say. Ethereum's a layer one, and I think that if you look at it as a programming technology and a application environment, we've seen this before in tech, right? Like an application will use many stacks. Like for example, Facebook used to use PHP, but actually, if you were to ask what's it run on today, there's probably about 50 different technologies that it uses, and we've seen that with Tether as well. What transport layer does it use? It uses most of the large ones. Actually, Tron is big. It used to be mainly Ethereum. Before that, it used to be on Bitcoin, actually. And so I don't think the lock-ins are just as strong as people think. The network effects are weaker because these are actually languages, not um, like protocols. Bitcoin is a protocol because there's a very simple messaging. So I think, I'll stand out and say I think the entire TradFi world's got it wrong, and I think most of crypto's got it wrong. That coming from a engineering background and a startup guy, I think of these as languages and development environments. And I think even this cycle, people are starting to realize that. And the addressable market for Ethereum is much smaller than Bitcoin. So over the next 10, 20 years, we'll see that play out, I think. But sure, you run an ETF and offer that to TradFi. It's going to be useful. Hedge funds are going to trade it. And obviously, we talked a bit about capital rotation from Bitcoin, Ethereum, big caps, mid and low caps as cycle runs on. That's going to be useful to trading firms. I do not think that Ethereum is a great hold. I don't think it's ultrasound money. So just bear that in mind. But that's my, opinionated opinion.
I definitely agree with the long-term thesis period, but from a strictly cyclical investment perspective, I think it's holding its weight now. It finally has something that people can rally behind, and I think this is a general positive effect into other protocols, and probably a good thing for us to be able to identify winners and losers and down the line. But we will see. Definitely something we will be actively monitoring. Do you see similar situation in 2021 where we have a local top in 25, macro top in 26? I'm going to add another point to this, which is a question that came about the Federal Reserve chair and the impact that would have if he left. I think we always have to differentiate market expectations versus economic progression, right? So remember that the finance part or the financial system and the economy as a whole are two different things that sometimes very closely track each other, but can have moments where there's massive dislocation, massive irrational exuberance between the two things. And I think the Fed and the Federal Reserve and the Fed chair are not able to influence demand. If I give Willy $10,000 tomorrow, that doesn't necessarily impact his, the way that he acts or goes about buying things in his life. It could not. If you take that on an average, there's going to be certain people that take that $10,000, they do something with it. Other people save it. Other people pay down their debt, right? So it really depends on how that money actually gets used. And I think there's always a misnomer between that and the impact in the real economy. Printing money or increasing credit does not have a direct impact on the economy if the demand or the feeling, the good feeling that people have, that the economy is going to be prosperous and that they're going to have a job and all these things are not there, they're not going to spend the money, right? So we just have to look at these things in two separate ways. In terms of the local top that we saw in 21, I think we will definitely see a local top in 25, just based on structural analysis. I would give it an 80-20, a 20% chance that we are in a different environment. So this time is different versus this time is actually the same as every other time. But again, like we said before, we're not in the business of predicting as much as in the business of actually trying to track and make sense of how things develop. And that's going to be the strength, hopefully, of our framework that we've developed together with Willy Woo.
Yeah, I think
not sure, Willy, if you have, yeah.
On that last point, it's very, very important that predictions. I actually think predictions are dangerous because you're just looking at a price target or a date target, but there's no such thing as a crystal ball. And so what you really want to do is have a full picture of the entire structure and what the risks are. And for every person, it's a different need in how they manage their own assets. So it's much more useful to paint the whole picture of the structure and what could happen. So just want to reiterate that point.
Yeah. There's another question to follow up. So for those of you that are planning to cash out, there's a question coming from the UK about cashing out in British pounds versus USD, how we see the DXY. I think this is definitely more of a question for Henrik because he's actually, I think, been on point with the DXY for the majority of this cycle. So the cycle is starting in late 22. My 50 cents on the topic is along these lines. I think the dollar is massively undervalued right now for many different reasons, ranging from geopolitical all the way to economic, right? For the fact that they passed a fiscal stimulus bill, which obviously has a net negative effect on how people perceive the value of the dollar versus other assets. But I would always remind people that once things change, and let's say if we do enter a recession, right? Let's assume that is the case. People are going to have there's going to be a massive flight to safety, and people are going to look for the thing that is perceived to be the most stable, and that will be the dollar this time. The dollar has not gone out the window. It is still the hegemon in the space. It is still the dominant currency that the world economy and trade and also credit and debt is being denominated in, and it will come back. I see within the next 6 months a situation where the dollar is going to gain massively, and is going to gain even more so if we actually get a recession, a pullback in liquidity, and a reduction in credit standards. So that's absolutely something we need to monitor. How that affects the British pound, that's a much more complex question. For those of you that actually want, we do have an in-house expert on the question and the topic of exchange rate risk. We could potentially have guest appearances on the show as well in the future, on the webinar, if that's something that is interesting to you guys. So we'll send out maybe a questionnaire or a poll on our Twitter to kind of see what you guys would like to see more of in the future. That might be a good idea.
Well, thanks for joining us. Do you wanna say anything there on your side, Yann?
Obviously, always great to hear your feedback, Willy. It's always, I think the liquidity part is fascinating. I think you're world class in that, so awesome to see.
Well, thank you. Yeah, so thanks for joining us, everybody. We do this sometimes near the end of the week, but not consistently every week. So just stay tuned to our Twitter handles, Swissblock __. We have the Bitcoin Vector handle as well, and the Altcoin Vector for those interested in trading the alt seasons. And my handle's Woonomic on X. So just keep an eye out if we do another one of these. So thanks for joining us, everyone. Catch you.